Good morning, everyone, and welcome to this morning's business webinar of the Franco-Nigerian Chamber of Commerce and Industry in partnership with Aelex on the Finance Act 2020 and taxation for non-resident entity. The event will commence in the next 8 minutes. Of course, we're always on time when it comes to our events, 8 minutes. And thank you for joining us early this morning. And we hope it's going to be an interactive session talking about the implications of the Finance Act 2020. And then, of course, the new chip in the block, which is the taxation for non-resident entities, as the arguments have been, what constitutes significant economic presence for companies. So I'm sure a lot of questions will be coming as we have with us this morning, the officer for the non-resident persons of the Federal Inland Revenue Service. So I think we don't have a better person than to have him here this morning that will be interacting with us on this topic. And of course, we have Mr. Theophilus Emua that will be harping on the same issue and then delving into the Finance Act 2020, the amendments made in the Finance Act 2019 as it affects the topic we're discussing this morning. We also have Tozaye Balogun, who is the Senior Manager Tax Advisory over at KPMG, that would also be talking about the same topic. So it's going to be an interactive session. For those on Facebook, I've gotten feedbacks that we don't mention those on Facebook. We have we usually have even higher views on Facebook when we come to our event. So the event is live on Facebook also. So those of us on Facebook, once again, good morning. And we look forward to having a fruitful interaction with you this morning. So we'll be on in the next 7 minutes. So sit tight as we commence the event in the next 7 minutes. Thank you once again. Good morning, everybody, and thank you very much for joining us this morning. Bonjour à tous, et j'espère que nous allons bien aujourd'hui. Bienvenue du webinaire de la Chambre de commerce et d'industrie franco-nigérienne en partenariat avec Aelex Partners with the topic implications of the Finance Act 2020 for your business and taxation for non-resident entity. Good morning, everyone, and I hope you are all fine this morning. Welcome to the webinar of the Franco-Nigerian Chamber of Commerce and Industry in partnership with Aelex Partners on the topic implications of the 2020 Finance Act. And of course, we're looking at taxation for non-resident entities. It's going to be a highly interactive discourse this morning. And for those of us that are live on Facebook, those of us that are here on this platform, we welcome all of you. On behalf of the Chairman, Board of Directors of the Chamber of Commerce, you are all welcome. So as we commence this morning, I will be introducing the Regional Economic Counselor of the Embassy of France in Nigeria. I will be represented this morning by his deputy to give us the welcome address, Mr. Williams Lamsel. Mr. Williams, please.
Okay. Good morning, everyone, and thank you, Moses, for this introduction. So the chairman and board members of the Franco-Nigerian Chamber of Commerce and Industry, managing partner, Aelex partner, tax controller of the Federal Inland Revenue Service of Nigeria, gentlemen of the press, distinguished ladies and gentlemen connected this morning. It is my pleasure to welcome you to this very important business webinar of the Franco-Nigerian Chamber of Commerce and Industry in partnership with Aelex on the 2020 Finance Act and its business implication. I am very glad indeed that the Chamber organized this webinar, because I think the 2020 Finance Act is really a critical reform for Nigeria. First of all, it is a critical reform because of the context in which it was approved. So as everyone knows, the crisis of the COVID-19 surprised and hit strongly all the countries around the world, and Nigeria, as many others, experienced recession last year. But the 2020 Finance Act is also a structural reform for Nigeria, for the Nigerian economy, as it involves many changes for the private sector, with over 80 amendments to the existing tax and regulatory legislations in Nigeria, such as the Companies Income Tax Act, the Value Added Tax Act as well, and the Petroleum Profit Tax Act, just to name a few of them. So as such, I would say that the Finance Act will contribute to shape the face of the Nigerian economy during this critical year, the year 2021, because after the much better than anticipated results for growth for the fourth quarter of the year 2020 that the National Bureau of Statistics just published last week, and the recession less than important than estimated by either the IMF or the World Bank for the year 2020. Also the oil prices that are going up for a few months now. I mean, all those good signals for Nigeria. Um, we can expect that 2021 will really be the year of economic recovery, and hopefully it will be a year full of opportunities for the startups, the MSMEs, and globally the private sector of the economy, and that will also rely on the reforms implemented by the federal government. So that being said, I commend once again the Chamber for putting this very important information session together in partnership with Aelex partner. And I look forward to a fruitful discussion as I welcome you once again. So thank you.
Merci beaucoup, Mr. Williams. Thank you very much for your welcome address. We indeed appreciate. And without much ado, ladies and gentlemen, I'll be introducing Mr. Theophilus Emua, who is a managing partner over at Aelex, to give us his opening remarks as we commence today's session. Mr. Theophilus, please.
Good morning, all. Thank you, Moses, for the introduction. It's once again, it's a pleasure to partner with Franco-Nigerian Chamber of Commerce and Industry in presenting this webinar. We've done, similar webinars in the past, and it's as you rightly said, it's a very topical issue. The Act has just been introduced. It has, introduced many changes, and taxpayers are wondering or trying to understand what these things mean. And that's why I'm glad that we have, no less a person than Mr. Bilaya Liu, who is a tax controller, especially for the non-resident persons, tax office, which is one of the areas where will be of most interest to, French companies and nationals. So I'm glad that we have this event. We are, as a law firm, are involved in this area. We do litigation, we do advising in different areas of tax. Some of our clients are French, some are from other parts of the world. But it's what we do, and I'm happy that we can, play a role in helping the public to better understand what the new legislation portends. So having said that, I think I'm happy to say let's get the show on the road.
Thank you very much, Mr. Theophilus Emu. Of course, we'll definitely get the show on the run this morning. Thank you, Aelex, for supporting this event. We have done a similar event on the Company and Allied Matters Act sometime in 2020, and this is the second time we're having this in partnership with Aelex. Thank you very much for always being in front as far as information dissemination is concerned, right? And then, of course, the advice you give to clients on all issues related to taxation, and the rest of them, it's great. Thank you very much once again. So we'll just happen straight to what we have this morning, ladies and gentlemen. It is the Finance Act 2020. And of course, taxation for non-resident entity, which is very, very new. And like I mentioned before, we are privileged to have the tax officer, the tax controller at the non-resident person's office of the Federal Inland Revenue Service. I think we don't have a better person than to have Mr. Abdullahi Aliyu this morning that will be talking to us about the implications of the Finance Act on the taxations of non-resident persons, the changes that was made in 2019 Act, and then, of course, the further explanation that was made for the Act in 2020. After he discusses on that issue, we're also going to have Miss Tozaye Balogun, which is a senior manager, deal advisory tax over at KPMG. She would also happen issues of the 2020 Finance Act, and also still put her voice on the taxation of non-resident entities. And of course, Mr. Imua would wrap up the discussion for us this morning. I'm sure we have a lot of questions. Questions have come even before the event already on this issue, especially the issues related to significant economic presence. A lot of confusion around that. People want to know what constitutes SEP and the rest of them. I will not jump over. We're going to wait for that time to come, and when we come, I'm sure we are going to be able to deal with that. So now I will be introducing Mr. Abdullahi Aliyu, who is the tax officer, non-resident person over the Federal Inland Revenue Service. The creation of a specialized tax office for non-resident taxpayers by the FRS is a step intended to further simplify tax administration in Nigeria and improve voluntary compliance by the affected taxpayers. This started sometime in 2019 in accordance with the provisions of the Company Income Tax Act and the Personal Income Tax Act. I think that is all I will say about it. Since we have the person here, Mr. Abdullahi Aliyu, Tax Officer, Office of Non-Resident Entities, Federal Inland Revenue Service. Mr. Abdullahi, please.
Okay, good morning, gentlemen. Good morning, the Deputy Commissioner, Nigerian Franco Chambers of Commerce, the Aelex partner, that's Mr. Tileos and Moses Sumaro, and my audience, good morning. It's wonderful, it's a wonderful pleasure to be in this webinar session on the discussion of the taxation of non-resident persons and then the implications of Finance Act 2020. Well, taxation of non-resident had been in Nigeria for a very long time, okay? But, it's never come into a limelight except a few years ago. The other started when it was a global problem when you have the BEPS. Issues of profit shifting started, and then the whole world just started looking to, how can we generate revenue? We are losing money from one side, and then the multinationals are taking the money out, and then for FRS come back and say, well, in fact, we have that sector, but we have neglected it for a very long period of time. We have not given it a due presence. The non-residence companies were being filed in different tax offices. And then, we have double taxation agreement with many countries, about 14 countries existing. So the decision was, we have treaties, we have multinational companies, non-resident companies, and an income in Nigeria, but nobody supervises it. We don't know, we cannot even have a record of that one. You don't have a statistic of that one. The management decided to say, okay, let's have a tax office to manage treaty and then the non-resident persons. Non-resident persons here mean both corporate and individuals. So that's how the idea of the non-resident person tax office came in. So we started with the existing ones under the fixed base of the former brick and mortar fixed base that you have to get a fixed base before you be taxed in Nigeria. But the global economy changes, and then the BEPS come out, action point one, digital economy come up, then Nigeria come up with idea, well, there's a significant economic presence, okay? These are all measures that we are all waiting for the big boards, that's the OECD, to come up with the final positions. But you know, once it delayed, many countries are coming with a form of, at least you can call it a unilateral measures. Nigeria will come up with at least an idea of set. Others are coming with digital service tax. So, but that's how Nigeria come up. For a non-resident person, it's simple. Nigerian system, we operate voluntary compliance. We have self-assessment regulation in 2011. That's the basis of our taxation in Nigeria. We expect the non-resident companies operating in Nigeria, you know, when we are operating the self-assessment regime, high reliability on the integrity and honesty of the taxpayer is being paid, because that one is a voluntary compliance. So we expect even the non-resident companies that they know they are earning income in Nigeria to voluntarily comply just simply by registering, filing tax returns, applying for tax clearance certificate, and the issuance of such. So the laws are not discriminatory once you come into the voluntary compliance. So what you need is just for you to comply. It is simple. Just identify yourself based on self-assessment regulations. You're operating business in Nigeria. Approach the non-resident tax office. You will get registered, and then you will have your own TIN number so that you'll be remitting your taxes. So I don't know. I have some little slides. Can I present it? And then how long do I have time so that I know how to manage it, Mr. Omaru?
Yes, you can. Of course, you can share the screen, and then you have about 15 minutes for the presentation now.
15 minutes more. Okay. So taxation of non-resident depending on the source rule. Okay. When you generate income in Nigeria, you are to pay the amount of tax on the source, on the amount you generated. Unlike a Nigerian company, when the Nigerian company is generating its own taxation is on global. But for a non-resident, it's just to the extent of amount of which you have generated. So we will subject you to the tax laws in Nigeria, the CETA, the PITA, the PPTA, the VAT, and then the FRS Establishment Act. But, you know, by the time you have a treaty, once you are coming from a treaty nation, then the provision of treaty takes over. Now we just go and treat you based on the provisions of the double taxation agreement. Particularly, like now we are talking those French companies who have double taxation agreement with France. So companies that are coming from France, of course, they have they have a double taxation agreement. So we can't use the DTA to. Sorry, I'm not sharing the screens. I'm very sorry.
Not yet. We can't.
Okay. You can see it now.
Yes, we can.
Fine. So once you're coming from French and a treaty partner, the provisions of the treaty takes over from our domestic laws. These are enshrined in section 45, 46 of personal of company income tax, the same thing with personal income tax, the same thing with PPT. So the provision, Nigerian tax laws are not discriminatory. It's the same thing with other non-resident companies are treated the same with Nigerian companies. So there is no discrimination in terms of those, except when you are from a treaty, we drop our domestic tax and then apply the treaty agreements. But for you to tax a non-resident company, there are three basic things you need to have. You have to establish you have the taxing right. You need to have a nexus to that tax. And then you need to have attribution of the profit that you can tax, because mind you, it's a cross-border transaction. The man is dealing with 2 or 3 or 4 different jurisdictions, of which, if he's taxed based on his own sourcehold, by the time he go back to his own home state, he's going to be taxed on global income. So what you are going to take that, do you have the taxing right of that to tax him? That's number one, 2 things you need to know. So the taxing right comes that, I have a taxing right, like the CETA of Nigeria, Section 9 covered everything that, any income that is generated, brought in, taxing right have come in now. Okay. Then the next thing, to what extent you cannot tax him except if you have except if you have the nexus to which you can establish that money is there. So the nexus now is coming to Section 13. That's our own former Section 13, of which we have the fixed base prior to the SEP order. The fixed base were fiscally on those with fiscal presence. But you know, when economic change, when technology growth, we realize that fixed base is not enough. There are other businesses that are coming up. They're generating a lot of income in various jurisdictions, okay? But they are not having that fixed base, so they are jumping. So Nigeria, part of the global, they came up with a significant economic presence order under Section 13.2. So that's how the digital guys were being captured under significant economic presence order. They are not fiscal presence, but they are virtually present. That's why we established a threshold for them once you have 25 million naira. So that will serve a virtual PE, because the fiscal PE is not possible based on the nature of the business transactions. So that's how FRS came up with, or Nigeria in general came up with a position of significant economic presence order. And that significant economic presence order, they have about two categories. There are those that are in streaming, those that have either website, those that have a medium of which they interact with customers in Nigeria. Okay, so those ones, they don't need to be in Nigeria, but through that medium, they will generate income in Nigeria. They have a lot of customers in Nigeria. So that one, so okay, for those category of taxpayers, once they establish a total revenue in Nigeria up to 25 million naira, that 25 million naira serve as a fixed base virtual PE. So for that purpose, they are expected to file return to tax in Nigeria. The other second category, there are group like what we call passive investors. Passive investors like the dividend, interest, royalty, and rent. So those that are rendering, furnishing technical, professional, management and consultancy services, these are considered to be second category, and then they are treated with withholding tax as 10% of the final tax. So those ones, they don't need to file any tax returns. The withholding tax taken from them is the final tax. Is the final tax on them, so no filing of tax. And that's category 2, they don't need to have 25 million naira. There is no threshold for them. There is no element of PE for them. Once you can have that consultancy, your technical or management services, you are rendering to a recipient in Nigeria, you don't need to have 25 million naira. Okay? With 1 naira word, your taxable 10% will be taken on that amount of 1 naira, and then it's final tax. Though the other aspect of the VAT, which is the consumer in Nigeria, will be taxed those ones. So that's why Section 13.2, the nexus to tax came in. After all, you have a tax right in Section 9 that have said any income generated in Nigeria, so we'll take this on source. Fine. The next one is the attribution. Attribution of the profit is difficult globally, not only to Nigeria. OECD and UN, they have tried, but up to now, they have not come up with final design. But Nigeria had what we use in Section 30, okay? In Section 30 of CETA have given Nigeria a power that, oh, you can take deemed profit, that's applying 20% of your total income. So if you have a revenue in Nigeria, and then you assume that we have given you 80% as cost, and then we will tax the 20%, 30% times 20%, which effectively 6% on the turnover. That's the mere attribution of attribution of profit based on CETA. And yeah, Peter 2, Section 7, the same thing applied, the same similar format. But if you will be able to file your account, okay, based on the self-assessment regulations, and you declare everything, and it's satisfactory to the board, then they will not reverse back to Section 30. Simply, Section 30 is an anti-avoidance. Once the tax authority is not satisfied with what you filed based on self-assessment, okay, they are not satisfied. There are 3 criteria there. That there is no accessible profit, or the accessible profit is not what they are expected, or is not comparable to the peers in the industry, fine. Then the revenue have that discretionary power based on Section 30 to apply that 6% effective on your total income. So that's the three criteria for you to tax non-resident persons. The taxing right, the nexus for you to tax in, and then amount, the element of profit, that's the attribution of profit. So generally, these are the background that I have based on my paper for taxation of the non-residents. So the other aspect I have here is the implication of the Finance Act 2020. So Finance Act 2020 introduced some changes that have impact on the 2019 and then pre-2019 tax law. So it makes some changes there. You know, we said the non-resident person that is serving for significant economic presence, say 25 million threshold, last year we said you should file an account. So it was not stated clearly, but this year is mandated because there was an argument last year that significant, how do I tax? And now it's clear that Finance Act 2020 comes with the fact that while you must register for VAT, you must file your account, and then you will file including the global account. Okay, that's what additional explanation of 2020 Finance Act. I don't want to take much time because I understand there are other presenters on that one. So, and then the step order that was introduced in CETA is now replicated in PITA 2. You have that step order of people involved in professional, technical, and consultancy are now replicated in PITA 2. So including individuals now, when you render that kind of business, you furnish that kind of business, so you too, you are subject to tax in Nigeria. But the order of the significant economic presence will be issued by the Minister of Finance. But I don't know, it may be similar to what happened in CETA, but you cannot preempt. That what happened in CETA, there was no threshold for the B part, but you cannot preempt what the minister will come up with SAFE rule in PITA. So the major changes that affected, we have CGT, CIT, PITA, and VAT. You can just go through briefly. And under capital gain tax, there's an exemption on disposal of aircraft used for international traffic. You know, international airline and international shipping are one of the major non-resident taxpayers. Okay. Prior to now, the implication was if you have your own, you are using the aircraft or ship for international traffic and you dispose it in Nigeria, capital gain tax will apply. But 2020 said no, capital gain tax is clear now, it's exempted those people that are not going to be taxed based on that one. Okay, CETA section 13.2, now exemption of filing of tax returns by companies whose income are subject to 10% withholding as final tax. So that one amended in 2019 because it was included, it was implied that last year, those that have withholding tax at 10% are liable to file tax returns. So there was an implication there. If those that filed suffered 10% withholding tax, by the time they file returns, if at the end of the day, the tax is not up to 10%, there will be an element of refund request. They may file for refund. So I think that's why they see that gap. They don't want to create that confusion. So that's why they have taken it off from filing. Once you pay, you suffer 10% withholding tax, you don't need to file tax returns on that one. CETA section 14.5, it was section over 14.4, that was the last, but now we have a new section of 5. Subsection 5 is based on the practical challenges we used to have with the shipping companies. Shipping lines in particular, we have less challenges with airlines. The shipping line, what they used to do, what is covered under section 14 and article 8 of the DTA is income on export freight. That's the value of what you load in stock, mail, goods, and passengers. That's the value. It's taxable under section 14 and under article 8 of the model tax conventions. But in practice, we used to have the international shipping line combining both the freight income and then the non-freight income. they lump it and then apply the rate of the freight incomes. So we have a lot of litigation issues on those ones. So that's why we say, okay, fine. The challenge they used to challenge is that, oh, it's not clear. It's okay, fine. We can make it clear now. That's how this section 14.5, the new section have come in, clearly differentiating the freight income and then the non-freight income. Anything that is non-freight income, there's no cover under section 14, there's no cover under article 8 if you're in DTA, it must be treated under article 7 of the DTA or section 9 of CETA, that's 14.5. Section CETA 1333.2 is just a reduction. That's the general. It's not only to non-residents, but it's applied to non-residents. So the minimum tax have reduced from 0.5 to 0.25, but this one is only for 2 years as a result of COVID. So the minimum tax now, instead of 0.5, it's now 0.25, but it's for 2 years, 2020, 2021 year of assessment. We don't know what will happen after 2021 finance act, but for now, that's why we have is for 2 years. And CETA 52 is imposed penalty on the amount of tax that is not correctly disclosed due to deliberate and dishonest act during self-assessment filing. You know, from the beginning, I told you that the tax administration of FRS is on self-assessment. On the self-assessment regime, we relied on the integrity and honesty of the taxpayer. So a taxpayer have that, after his annual account ended, 31st December, you have about 6 months. So the tax that is due on 31st December, based on self-assessment regulation, which is have 6 months, you don't pay any interest on that month. It's free. He will file his account on 30th June, you have a 6 months gap. After filing account 30th June, you still have about 2 months to pay, no interest. So, but sometimes taxpayers are misusing it, they are abusing it. So that's why they're saying, okay, after due date, when you are filing your account, you did not give us the true and this, and the one that you have not disclosed, interest will apply on that one. So that's the amendment in section 52 and 3. Section 55(1)(a) is now mandating the non-resident companies to file actual account. File actual account, that's a Nigerian operation, including the global financials. So the idea here is to help in the order. I know I've said the criteria for you to tax. You have 3 criteria: taxing right, the nexus, and then the attribution. And you know, Nigeria, we have signed into C/C reporting. So it's part of it. And then to establish data. So we need, by the time you are filing your account, you should give us your global financial position. You will help in the attribution of the profit, because there are various overlapping positions between OECD and UN on profit attribution. And then to comply with the C/C, we need your global financials. So that's the idea of the global financial. But prior to that one, there was a public notice in 2015 requesting all the non-resident companies to file actual accounts. So, but before that public notice, they are filing and paying taxes based on DIM. That's section 30 that I've described earlier. So now a non-resident company, either you are in digital, those that have fixed base already, they don't have that challenge. So you are in digital, you are streaming, you are sending any streaming, you are having customers in Nigeria, you are interacting with customers through a website or address or any platform, you are to file actual account, bring your global account. That's the implication of 55(1). CETA 63 is introduce a penalty, but the penalty on keeping of accounts, you know, a taxpayer is one of our reasons. Taxpayer need to keep proper books of accounts and records, okay, for compliance and then for enforcement. So in most cases, or in some cases, you'll find landlords that are not keeping proper book, or maybe for deliberate issue, they are not. So penalty have been imposed for that one. Prior to this one, there's no penalty for that one. This one is just to encourage taxpayers to be compliant. Now then you have 100,000 for the first month, 50,000 for subsequent months. And 68, make communication now between taxpayers and tax authority through email. You can file your email, you can file your tax return, you can pay your tax return, you can communicate with the tax office, and then it will serve as a purpose, as an effective means of communication. You can use it maybe you can use this as an evidence of proof of service. And then taxpayers here, they need to take this one, because sometimes when you have an assessment, you have a 30 days time to either object or to accept. So, when it's a physical copy, at least you'll be, but by the time when it's an email, you may likely overlook. So taxpayers are advised to monitor it very well if they want to take the option of objection. So CETA 77 amended the time of payment of taxes from 2 months. I earlier mentioned that you have 30 days filing of account on 30th of June, and you have 2 months after assessment to pay. But now 77 have changed it, so it's no longer 2 months, it's 30 days. So the 60 days have changed now to 30 days. So you have a reduced time to pay your self-assessment. That's one for CIT. For personal income tax, is the introduction. What you have saved in company income tax, that's what is introduced in the personal income tax. So we are waiting for minister to come up with the order. And then the second part, section 24 and 25, is on commencement and cessation. That one also is a replica of what happened in Finance Act 2019 for CETA. So the same thing applied to personal income tax for those individuals that are in trading. So there is no overlap in the succession, and commencement is on actual. On value-added tax, these are the one we have major this with the non-resident companies. Prior to this amendment, Section 10 of value-added tax was requesting a non-resident company or individual that is rendering taxable goods or services in Nigeria to register using the address of the person he is dealing business with in Nigeria. So we are having challenges a lot with those ones. And then when our VAT law was this in 1993, I think the idea or even the knowledge of the complications of business was not much there, but the challenges have grown now. That VAT was envisaging only transaction between B to B. But now development have come up, technology has grown. Okay, we realize that there are a lot of business transactions that can be done between B to C. For instance, the digital guys are major. He'll be offshore and then having a lot of customers in Nigeria. So if you apply that law, that using the address of the person you have existing business, you are having the challenges there. How many of them are you going to use the 1,000 customers you have in Nigeria and register with them? So we are having challenges with that. So that's the idea of amending this one to make sure that, now issue of saying the address of the person you have is no longer there. As a non-resident company and you are rendering serviceable, vatable goods or services in Nigeria, you are duty bound, you are mandated to register and get your tax identification number. And FRS is coming up with a guideline on appointment of agents for collections, okay? So you preempt that one, we are waiting for the agents of collections. We are waiting for the guideline to come up. So by the time the guideline come up, it would clear the challenges of B to C, okay? You may appoint an agent that will collect. Based on practice, what we observe for those that are dealing with B to C, you will see that, okay, they will say, I have registered, I have invoiced, and included the VAT on that one. And then I leave it to the customers based on that existing law before this amendment. So in most cases, you will find that those customers, the VAT, in fact, number one, some of them may not be registered, their customers. Number two, some of them would be below the threshold. We have a threshold of 25 million, which they are not registering for VAT, they are not filing. And some, the cost of compliance will be higher than the tax. For instance, we have a tax of 5,000 naira, 500 naira, And for you to, the cost of compliance for you to go to the bank, do whatever, all this thing and pay, it may cost you 1,000 naira or 2,000 naira. So they may decide not to. So by the time the FRS will come up with the guidelines on the collection, and then we are appointing agent to at least clear that aspect, either to use those companies itself as a collecting agent, or you will have a separate collecting agent. But we are waiting for the outcome of FRS on that one, and I'm sure it's not going to take a long time. So it's just going to be coming out very soon. So it will take care of the issues of the B to C. So that's the major thing in VAT. In Establishment Act, the amendment came into, because FRS have joined this is a global list in multilateral, this in international.
Mr. Lee, sorry, you might have to just quickly round up now, so that yes, because so you can go to.
Okay. So the summary in Finance Establishment Act, what we have given is the powers of FRS to assist in exchange of information, assist in collection of taxes, and then FRS have been empowered now to use proprietary technology to collect taxes. And another good thing for all the taxpayers, including the non-resident, is there is now a dedicated account for refund mechanism. In case if you have genuine reason, you have a refund, then your father is an established, there was a refund account, but now it should be managed by FRS, so it will be more effective now. And okay, information now, since FRS is mandated to use proprietary design, banks and other agencies are also mandated to provide FRS with all the required information. This implication that maybe the gateways of the digital may be supervised very well now. So that's it. In conclusion, taxation of non-resident persons in Nigeria is similar to other parts of the world, where source jurisdictions to get their own fair share of taxes from non-resident earnings, income in their jurisdictions. The Finance Act 2020 amendment brings more clarity to VAT registration and grant FRS powers to deploy technology in gathering information and tax collection. This further indicates that the government is supposed to collect as much as possible from the non-resident, digital economy in particular, and to curb evasion and evasive avoidance by both non-resident and resident taxpayers. We expect that when fully these changes hopefully to return the country to part of recovery. So we have a simplified registration. What you need to know to do as a non-resident company, just contact the non-resident person tax office, which easily register you. We don't need to come to Nigeria. We don't need to travel. Just go to our email. We'll give you the simplified form, register. We'll give you this account, the JP Morgan account, that's the domiciliary account of FRS. We make your payment, not necessarily coming to Nigeria. From registration to filing of your accounts to application of tax clearance certificate is possible. We can do it, not necessarily coming to Nigeria. Thank you very much, and I sincerely appreciate for being part of this webinar session. Thank you.
Thank you very much, Mr. Liu. I personally enjoyed your presentation. Can you stop sharing your screen, sir? Maybe I'll do that for you from here. Thank you, Mr. Liu. I personally enjoyed your presentation. Very robust and touching various areas and taxation for non-resident persons. Of course, going to the Finance Act, where you mentioned the three tenets that determines what you're talking about: the rights to tax, the nexus, and the elements of profit. And of course, one thing we really enjoyed is the fact that the Finance Act has given provisions for the integration of technology. Like you mentioned, using emails to respond to, complaints and all of that when it comes to this. So I don't want to start summarizing the whole thing right now, because we'll go to the next speaker. Of course, we're going to have a lot of questions. We have questions for you already from the participants. Yes, but we'll have to quickly get to question and answer session, and then we can be able to have those questions together. So without wasting much time, I will get to Ms. Tozaye Balogun, who is a senior manager, deal advisory tax over at KPMG. to give us her own presentation on the Finance Act 2020, focusing on issues related to taxation. So the areas that Mr. Abdullahi has mentioned, you can just quickly, just hop over it so that we just have, new areas, and then we can have a broader understanding of the Finance Act 2020. Mr. Zaib, and please, I want to mention that KPMG was really part of the brands that really worked on the Finance Act in collaboration with the federal government. And we're privileged to have Tozaid here this morning. That, of course, was also really part of that. Aelex also was also part of that too. Thank you very much. And it's a lot of work, and we really appreciate that. Madam Tozaid, over to you.
Thank you very much. Good morning, everybody. It's a pleasure to be here today. So very quickly, because we're pressed for time, I'll just touch on the other aspects of the Finance Act 2020 that I believe would be relevant to non-resident companies and foreign-owned businesses in Nigeria. So as a background, I will just touch on the economic imperatives and key drivers for the Finance Act. So given the state of the economy and the global pandemic last year, and which has also even flowed into 2021, it became imperative for the government to introduce tax law changes that can generate sufficient revenue to support the annual budget, while bearing in mind the financial constraints suffered by businesses. So some of the major tenets and the reasoning behind the Finance Act 2020 essentially was that no new taxes should be introduced, because then that would be punitive and wouldn't be taking into cognizance the state of the economy. No new tax incentives, because the government actually does need cash to run the economy. And then tax reforms that support financial stimulus, and then tax measures that are short, focused, and uncontroversial. So the Finance Act is staged across 5 major thematic areas, which are as follows: enacting counter-cyclical measures and crisis intervention initiatives, easing doing of business, like my colleague from the FRS has touched on. Now there is a non-resident tax office that simplifies the tax administration process for non-resident companies. Also, tax and fiscal responsibility is one of the major thematic areas. So in this Finance Act, we see that there have been amendments to the Fiscal Responsibility Act and even the Public Procurement Act. And then also one of the thematic areas is to grant fiscal relief for mass transit. All in all, 14 laws were amended with over 80 tax amendments. So I'll just slide into the key provisions that we believe should be relevant to foreign companies and foreign-owned businesses in Nigeria. As you can see, the first point I have is significant economic presence, but my colleague from the FRS has discussed that extensively, so I'll just gloss over that. However, I'll be happy to take specific questions directed at me in respect of significant economic presence. He's also touched on the changes to the law for international shipping companies. So I would skip that and then go to tax compliance requirements for NRCs. So I just want to emphasize the fact that if as an NRC, you earn income that is only liable to withholding tax in Nigeria, so you earn passive income, or you are brought into, or you have a significant economic presence in Nigeria by virtue of the fact that you provide professional services, consultancy services, technical services remotely, and that income that you generate is only liable to full and final withholding tax, you're no longer required to file tax returns. However, if you have different sources of income from Nigeria, some of which include passive income, or some of which include income that I have just spoken about under the SCP rule, so technical management fees that is liable only to a final withholding tax. And then you actually have income from other sources, perhaps assuming you were to have it, for instance, if you had a fixed base in Nigeria, or even if you have a digital significant economic presence. So to the extent that you have various buckets or various sources of income from Nigeria, some of which are liable to a full and final withholding tax, and some of which are liable to 30% corporation tax, then you'd have to file a tax return in Nigeria. And for the purpose of filing a tax return, you'd have to submit your global audited financial statements and books of accounts for your Nigeria operations as attested to by a certified accountant. So non-resident companies are also required to register for VAT, file monthly VAT returns, and fulfill other Nigerian VAT obligations. Some of these obligations can include showing Nigerian VAT on the face of your invoice, ensuring that you obtain your taxpayer's tax identification number, particularly if you are entering into a B2C transaction. Finance Act 2020 also limits the scope of tax incentives available to banks that advance agricultural businesses with a loan. Hitherto, once you were engaged in agricultural business, be it primary, secondary, or on any spectrum of the value chain, loans granted to you by a bank could have enjoyed 100% withholding tax exemption to the extent that in advancing you the loan, the bank had granted you an 18-month moratorium. With Finance Act 2020, the game has changed. So the scope of companies that can entitle a financial institution to tax exemption has been limited to companies engaged in primary agricultural production. Primary agricultural production means primary crop, livestock, forestry, and fishery production. The Act gives detailed examples of what constitutes primary crop, livestock, forestry, and fishery production. Now, this incentive is only available to the banks to the extent that the banks extend you the loan with a 12-month moratorium period. The scope of excise duty has also been expanded by the Finance Act 2020. So prior to Finance Act 2019, excise duty was only levied on excisable goods locally produced or manufactured in Nigeria. Finance Act 2020 attempted to widen the bucket by subjecting excisable goods imported into Nigeria to excise duty. However, Finance Act 2019 also created certain exemptions for excisable goods imported into Nigeria in raw or finished products to the extent that there is no locally manufactured alternative. Now, FA 2020 has gone back and rescinded the exemption introduced in 2019 and has taken us to a place where all excisable goods, be it locally manufactured or imported into Nigeria in raw or finished form, will now be liable to excise duty in Nigeria. There has also been introduced a framework for subjecting telecommunication services to excise duty in Nigeria. This hasn't yet been activated because the Finance Act introduces a clause that makes it mandatory for the president to order that excise duty become chargeable on telecommunication services. So we can expect to see some form of presidential order or directive when the government is ready to activate this framework in the law. Import duty and VAT exemption has now been granted on the importation of purchased or leased commercial aircrafts, engines, and spare parts. So I'm aware that in the industry, there was some informal discussion and perhaps even in principle, this was the case. So now it's a welcome relief for industry operators that this has finally been codified into the law. So it's no longer subjective. Non-resident companies or commercial aircraft registered in Nigeria can rest assured knowing that whenever they import aircrafts, engines, spare parts, or any of its component parts into Nigeria, this importation will be done duty-free and VAT exemption-free and VAT-free. Import duty and levy on passenger vehicles has also been reduced. So for import duty on mass transit, there's been a reduction from 35% to 10%, and on import levy on cars has also been reduced from 30% to 5%. There have been several amendments introduced by the Finance Act in permitting the use of technology for effective and seamless tax administration. So one of the amendments now is that tax officials can use technology to collect tax information and to ease tax administration. Obviously, we recognize that with the use of technology, some caution has to be taken by tax officials. So the Finance Act has also matched this provision with a penalty regime for tax officials who breach taxpayer confidentiality by sharing information with unauthorized third parties. Now the FIRS can deploy proprietary or third-party payment processing or other digital platform or application to collect and remit taxes due on international transactions in the supply of digital services only. So I think it's important that we cast our mind to the fact that the remit for this use of technology is international transactions in the supply of digital services. So this doesn't cover every other kind of international transaction. Now, electronic correspondence is now, the use of electronic correspondence in interacting with tax officials is now backed by law. At the beginning of the mandatory lockdown, I'm aware that taxpayers were corresponding with the Revenue Authority via email and other electronic means. So what the Finance Act 2020 has done is just codify this into the law. Also, Tax Appeal Tribunal may now conduct their proceedings virtually. So there's temporary reduction of minimum tax rate by 50% from 0.5 to 0.25 for tax assessment, for tax year commencing 1st of January 2020 and ending by 31st of December 2021. So the implication of this is financial years 2019 and 2020, essentially. Now, it begs the question, how would this operate? Because the law was introduced the law became effective 1st of January 2021. However, the reduction in minimum tax rate applies to 2019 financial years. The expectation is that most taxpayers who had financial years ending in 2019 would have filed their tax returns during the course of the 2020 financial year. So the question therefore arises, are such taxpayers entitled to a refund or a rebate, or how do you apply the law, given that it was only introduced in 2021, but it covers a retrospective period? So it will be great if our colleagues from the FIRS can weigh in on this point and give taxpayers guidance on this. Companies operating in free trade zones are now required to file tax returns in accordance with Section 55 of the CIT Act to the FIRS. This is a deviation from what obtained before, being that companies operating in the free trade zone were not statutorily required to file returns with the FIRS. The point to this amendment is to facilitate information sharing and gathering by the FIRS. Is not intended to bring such companies into the Nigerian tax net if they are not already in the Nigerian tax net. It's just to facilitate transparency of information. Another major introduction in the Finance Act 2020 is the establishment of the Crisis Intervention Fund and the Unclaimed Funds Trust Fund sub-fund. So the Unclaimed Funds Trust Fund sub-fund is one of the sources for financing the Crisis Intervention Fund and for financing the nation in the event of a pandemic such as COVID or any other similar exigencies. Now, the funds that are to be transferred into the Unclaimed Funds Trust Fund include unclaimed dividends of public limited liability companies quoted on the NSE and unutilized amounts in dormant bank accounts that have remained so for 6 years. These funds are to be transferred to the Unclaimed Funds Trust Fund immediately, i.e. effective 1st of January 2021. The fund will be managed by the Debt Management Office, and the fund is essentially a perpetual debt, and owners of the unclaimed dividend or owners of the unutilized bank accounts can make a claim on the fund at any time for their money, and the money should be given back to them with interest accruing on it, depending on whether interest has actually accrued on the fund. Now, it is a punishable offense for companies to not comply with this directive. I believe the penalty for failure to comply is 5 times the amount not transferred into the fund, plus interest at the prevailing monetary policy rate. Another important amendment is to Public Procurement Act, and specifically in respect of government contracts. So now the maximum mobilization fee for government contracts has been increased to 30% from 15%. However, bank guarantee or insurance bond issued is still a requirement. And in lieu of a performance guarantee, an insurance bond may also be accepted as a precondition for the award of a procurement contract and payment of mobilization fee. And such guarantee or bond must not be less than 10% of the contract value. Other general reforms are donations in cash or kind made by companies to any fund set up by the government or its agency for any pandemic, natural disaster, or other exigency may qualify as tax deductible, subject to certain conditions. So essentially, if you donate into the crisis intervention fund, then you can take a tax deduction for it, subject to meeting certain conditions in the CIT Act. Electronic levy now replaces stamp duty on electronic transactions. This is I would say this is a cosmetic change. It doesn't, the base and the rate and the manner in which the tax is applied hasn't changed. It's just the name of the tax has essentially changed. There's also a requirement to charge capital gains on compensation for loss of office payments exceeding 10 million. A new filing regime, a new compliance regime has been introduced for capital gains tax. Now returns are to be filed by 30 June and 31st of December every year. And the law has also clarified now that if as an employer, you pay your employee compensation for loss of office, you have a requirement to render accounts to the FIRS or the state tax authority, as the case may be, of the capital gains due on the compensation for loss of office exceeding 10 million. Qualifying capital expenditure incurred in the acquisition or development of software now qualifies for capital allowance. This is good news, as more and more we see that companies incur expenditure on the acquisition or development of software and technology required for their businesses. Now, the law has clarified that FIRS must use adhesive stamps issued by the Nine Post to stamp dutiable instruments. This resolves the controversy on what kind of adhesive stamps can be used for the purpose of stamping dutiable instruments. So I've come to the end of my presentation. I would be right here available to answer any specific questions directed at me or any other general questions on the topic, on the issues that have been discussed.
Thank you very much, Ms. Tozaye Balogun. Thank you for the robust presentation you have made on the elements of the Finance Act. I'm indeed delighted to see that you have also thrown indirectly a question for my own book to Mr. Ali already on the dates for the exemption from 0.5 to 0.25%, where you mentioned that already before. Thank you very much. We'll come back to a lot of questions. I'm sure a lot of people have a lot of questions to ask. But of course, to wrap up the discussion this morning is Mr. Theophilus Emua. We'll be wrapping up discussion. Then we quickly dedicate 25, 30 minutes to have one or two to have to deal with the questions that are in front of us already. Mr. Theophilus, please.
Thank you very much, Moses. And it's been very interesting listening to the two previous speakers. They've covered the field, so to speak. So what I will do is just touch on a few areas where I think there is still There are still conversations to be had because there will be disputes between taxpayer and tax collector. I mean, that is something that we're in the business of. Some of these matters that have been mentioned, we're actually, engaged in disputes with the tax authorities at the TAT and the courts right now. So I won't go into details of some of those matters. But the last thing that Tuzaya mentioned about stamping of documents, it's still, to my mind, a controversial issue. Now, the Stamp Duties Act says you have a document or an instrument to be stamped, you go to the Stamp Duties Commissioner, he assesses it, and he tells you how much you have to pay, you pay, and he puts an imprint on the document saying stamp duty paid. Now, some documents are for large, transactions. The stamp duty may be ₦1 million. I've paid stamp duty that run into tens of millions of naira. Now, if we say that post office stamps are to be used, my question would be, how do you, first of all, where will you stamp? Where will you get? First of all, how do you get ₦1 million in stamps? And then how do you paste it on the instrument? So I don't know what I know there's been a dispute between NIPOST and the Stamp Duty Office about who has, the role or the authority to stamp instruments. And I don't know that this has resolved it. This has possibly created another problem. Because if I have a document of, be stamped for ₦1 million, that number of stamps will not cover a large, many pages. So I think that's something that still needs to be looked at. And I'm sure, Mr. Ali will take word back to the people concerned.
Can I just chime in on that point before you?
Yes, go on.
Okay. Because now there's a definition of stamp in the Finance Act that includes electronic stamps. So I imagine that in scenarios like this, then an electronic stamp may have to be used or substituted for an adhesive stamp. Now, we don't know, there's still a gray area here, like who designs this electronic stamp.
Exactly. That's why I say it's still a battle between the two of them.
Yes.
Who has power. You see, so if the Stamp Duty Commissioner can do the electronic stamp, then nothing has changed. That's what he's been doing all along anyway.
Yeah.
But if you say, go on.
Yeah, you're right on that point. But they've only said if it's an adhesive stamp, you must use the ones produced by NIPOST. So it actually gives a whole room for discussion and potentially even controversy.
Yeah, and it's a battle between government departments. It has nothing to do with the taxpayer, So why they should be able to resolve it within government, rather than put the taxpayer in the middle of this battle. Anyway, another thing I wanted to touch on is technology. I mean, many new innovations have come in this area in taxation, and to implement those things in a country of 200 million people, I suppose you cannot do without technology. And so it's interesting that the FIS has been empowered to use technology to do some of these things. We may not remember, though, that even before the Finance Act 2020 and Finance Act 2019, the FIS already had power to demand from any bank your bank account details. So they could ask for your bank statement from any bank. They didn't need a court order. In fact, 3 or so years ago, they used this power to determine that some taxpayers had turnovers of 10 billion and were paying no tax, and they were asking the banks to block those accounts until the taxpayer showed up to pay the appropriate tax. So they were already using those powers without the Finance Act. So that power already existed. This extends it to other things. So now they can go into retailers, and we have a client who's in retail, and they plug into their cash tills, and so they can see the revenue, and by the end of the month they can determine how much VAT is to be paid without having to wait for a return to be filed by the taxpayer. So this is interesting use of technology, and I think going into digital taxation of digital services, it will become even more important, because rarely these are things happening online. You don't see anything tangible except when the actual goods arrive at the purchaser's home. So the taxman may have no idea what has happened. So without technology, he will not be able to catch it. In some countries, they've begun to use artificial intelligence to do some of these things, to profile and work out, where the tax, liability should be and who should be paid. So it's interesting that they've extended this ability to use technology. How it works in practice will be only time will tell, but it will be interesting to see how it works. But of course, all this is not, they're not introducing new taxes, they're simply introducing a new way to determine what you owe, which was something that they didn't have before, and so many people escaped because nobody even knew it existed. Another thing that they will begin to use, which will enable them, is this thing called BVN, Bank Verification Number. Not many countries have it. I speak to my friends from Europe and America, and when I tell them about BVN, they're surprised, because it means that with the BVN, the government can tell all the accounts that you control. And with this additional power, they can then tell how much money you've made in those various different accounts. So you can't hide anymore. So by the time they couple the BVN platform with these other platforms, I think it'll be difficult for people to escape the taxman's lenses. So that's another thing that we need to note as taxpayers. Of course, most of the people in this audience are in compliance. They choose to be compliant. But those who have not been complying need to know that from going forward, that it may not be the same business as usual. One other thing I wanted to ask is, with regard to free zone entities, there's another point of controversy. I know that up till now, it wasn't clear whether they needed to file tax returns. But another thing that wasn't clear was, if they made a payment to somebody who was taxable, did they need to deduct withholding tax? And I do know that this provision has answered that question. It says the free zone entity must file tax returns with regard to its own operations. But where it is paying, a taxable person, must it deduct withholding or not? And that has also been another area of controversy. I will just leave those few questions for not necessarily Mr. Aliu, but at least just for you to think about. You doesn't have to have the answer today. But at least we know that there are some things that still need to be looked at. On that note, I'll hand over to Moses and go on to the question and answer.
Thank you very much, Mr. Imoa, for bringing some gray areas out again to make this whole thing, to make it more robust. I do not know if we can be able to finish as at the time we have scheduled for today's event, but let's see how much we can go, because the issue of taxation is a very, very big issue. And of course, the conversation continues. I would love to take Mr. Aliu's permission. So even after today's event, Mr. Aliu, is it possible that we can receive emails of questions, since FRS is using technology now for all of these things? We can receive email as questions and then send across to you, and then you give us the answers later. Because of course, I know that a lot of questions are going to come. Right now, we can't even pick the questions that are on Facebook, because we're just using this platform right now to be able to get the conversations going. Right.
Yeah.
So
no problem. You can send questions anytime.
Oh, great. Thank you very much for that.
Yeah.
And of course, your presentation would also be needed also, so that we can be able to circulate around to even those that did not even participate this morning. And of course, the video would also be on YouTube afterwards. People can go and watch it over and over again, and definitely you reach out to us, and then we can get your questions across to Mr. Lee. Thank you very much for that. So I'm going to start with the questions from the audience this morning. Okay, we have this from an anonymous question. I need clarification on why we have two different dates for filing of capital gains tax, CGT. I do not know if Josiah can intervene. You can come into that, but not now. And Dotsun Oluwole has asked, I want to know if the VAT to be deducted from invoices is now on cash basis or accrual basis, right? Yes. On another attendee has asked again, on the free trade zone entities, are they now going to be expected to file transfer pricing returns, considering the new obligations on them to the file tax returns. Yeah, I do not know if Mr. Emowa can harp on that. Possibly, that will be much later. Okay. Now, there are other questions here. Number one, on the issue of non-resident taxation. A non-resident is liable for taxation on income derived or received from Nigeria. Nigeria tax defines a non-resident individual as a person who derives income from Nigeria but is not domiciled in Nigeria or does not stay in Nigeria for more than 183 days within a 12-month period. I think some participants need more clarity on this, the issue of 183 days and they're not being in Nigeria. Now, the issue of significant economic presence, it's a very big issue that I will throw to all speakers this morning. You can touch on it a bit, right? Because at some point, someone is asking that, using technology now and the whole of this whole thing that is in front of us, they're asking, okay, for example, they say there's a website that if your website ends with .ng, that is where it comes in. If it ends with .com, it does not apply. If it ends with .org, it does not apply. There's a lot of questions around, those that are not here in Nigeria, but of course doing business in Nigeria using the World Wide Web. Understand? So does this issue of .ng, .org, .com come into play as far as non-residents is concerned? Yeah, we can start with that, and other questions are coming up later. I'll start with Mr. Liu, please.
Okay, thank you very much. There are questions, there are discussions that were mentioned by my two colleagues. Yes. But the first of all, before I go into those ones, I want to make an appeal, particularly for this, using this forum. I know we are dealing with the Franco-born companies. We, Nigeria, have a double taxation agreement with France. So there is a lot of tax incentive and benefit for those companies. But I'm just appealing, let them just come up and comply using the voluntary self-assessment regulations. So that's my first appeal before we go there. So do I start with the last issue raised of non-residents spending 183 days? Do I start with that one? Taxation of individuals for corporate is registration for Nigerian tax purposes. Once you are incorporated in Nigeria, you are deemed to be a Nigerian taxpayer. Irrespective of ownership, you will be 100% owned by foreigners, but you are incorporated under Corporate Affairs Commission. You are deemed to be a Nigerian taxpayer. But for individuals, we use what we call residency, and that is not only to Nigeria, it's applied globally, except I think very few jurisdictions like US where they're using citizens. So the cutoff date for taxation of individual is based on residency. The residency of 183 days, that's half year, maybe approximately, is that we are going back to the source rule and then the filing tax obligation. So once you spend less than 183 days in Nigeria, your filing obligation remains with your country of origin, but you earn income in Nigeria. So based on source rule, you are supposed to drop the element of tax in Nigeria. That's why the non-resident are being taxed by federal government. But once you are a non-resident individual, but you earn income in Nigeria, spending time more than 183 days, then you are now tax resident in Nigeria for tax purposes. Okay, you may be an expatriate, but once you spend more than 183 days, you are now duty bound to file your tax return with one of the state board of internal revenue. You get it? So that's the cutoff. Less than 183 days, you are liable under FRS. More than 183 days, you are transiting to state board of internal revenue. Then obligation of filing tax returns come in. So you are less than 183 days, then are you from a DTA country? All these criteria will come out. Did you spend the time threshold for you to be taxed? Then those things will come up. So the cutoff 183 days, that's the implication of it. Less than 183 days, you are still duty bound to file your tax return in your country of origin, but you will pay the element of tax based on source rule to federal government of Nigeria. When you spend more than 183 days in Nigeria, you are duty bound to file your tax return in Nigeria to any of the state board of internal revenue in the state you are resident. Okay, so I think that one will clarify that one. So there's another questions you mentioned about is it filing tax return? No, it's for Mr. Umar, so let me not jump there. The difference, value-added tax, whether it will be by cash and accrual. We had a lot of battle on that one. Some are saying that, do I borrow money to pay VAT? You know, it was on invoice, okay? If you look at the value of the VAT is on your invoice. Now, a running battle that they are saying, no, should I go and borrow? I've issued, but they have not paid me. I have issued of bad debts, okay? So I think that's what the Finance Act of 2019 came about. There's a lot of pressure, I think, is around that. Okay, once you have done your transactions, you can pay this on cash. That's what happening even within the government cycles. You know, when you do contract, they will deduct the VAT and the withholding tax at the point of payment. So the accrual issue was causing a lot of issues there. I think they now settled down. You know, the Finance Act, let me just, take you a little bit off. Finance Act is Nigerian project. It's not a FRS project. My sister, Tozaye, can confirm. In fact, I'm telling you, it's not FRS. Don't look at Finance Act and say it's FRS. It's Nigerian. Tozaye have much more influence in Finance Act than me. I can confirm to you for free. So it's a Nigerian project. All the stakeholders are involved. So there are so many. In fact, if you look 2019 Finance Act, it's more of private sector. Tozaye and Co, they have much more influence there. But you know, when the interests overlap, sometimes we come up with this thing. That's why 2020, when we are able to get some of point through, at least it's a balance this thing. Though learning this into the trend of this thing I've come up to. We started 2019 for a very long time. So we studied some of our errors and mistakes there and then corrected. I believe 2021 will be better. So on SEP, we have...
Mr. Ali, we have talked one or two questions before you go on.
Okay, sir.
So what you are saying about VAT means that even government departments will not comply with the law as written at the time because they were not paying the VAT on invoice.
In fact, you know, that's a cruel basis of VAT. It was a serious matter. Someone will go, based on practice, someone will come and say, okay, I have invoice, and they have not collected money. And then, in fact, the invoice, the man got into this thing, is bankrupt.
Yeah.
What do I do?
Yeah, true.
Do I ask for refunds? So the procedures was this thing. That's why I'm saying, because I were able to bring the taxpayers' view in the VAT or accrual to cash basis.
Then another question I have is, you mentioned that if it's less than 183 days, you pay to the federal
state. Less than 183 days to FIS.
In other words, if somebody, I think many people don't realize that taxation of individuals, if a musician comes to Nigeria and is paid $500,000 to appear in a show for 2 days and go back to their country, they are taxable in Nigeria in respect of that.
To the extent of the amount you generated in Nigeria.
Exactly. So when they come for these 2-day things, appear at a show in Nigeria and go back, they are taxable.
Yeah. But unless the entertainer is coming from a country that has a treaty with Nigeria. Because treaty rules introduce some exceptions, and treaty rules usually have the 183-day rule. Yes. So the people who will typically be captured by 2 days are people who are coming from non-treaty countries.
Professionals. I think
my sister, if you are talking about 183 days, you are going back to employment income. Section 10 of PTA.
For independent artists, I think they have different provision.
So those that are generating income generally on trade and this one, that provision may not likely apply to them. Look at section 2B1 for Peter. I've stated those non-residents that are.
I mean, I agree with you on that, but I'm saying if the non-resident is earning income from Nigeria, but the non-resident is coming from a treaty jurisdiction, then you have to test it from the point of view of the treaty to evaluate whether that person. So let's just not. I just don't want a blanket statement.
Yeah, you have a point, but given that we only have about a dozen treaties, then the 200 other countries in the world, there are no treaties with them.
So, if you have a treaty with Nigeria, then you can go back and offset using Article 23 of Elimination of Double Taxation. can apply those.
Anyway, the point I just wanted to make was that people needed to realize that if somebody comes in for 2 days, he can still be taxable in Nigeria.
He can still be taxable.
Many people think that you have to be here for 180 feet.
No. You are taxable in Nigeria. Go back to your home state and then declare your global income, and then the taxes you suffered, because you are losing a lot. In fact, it's a window. A lot of money is going out there. That's why we are coming up now. In fact, we are trying
but a lot of Nigerian artists go out as well.
Oh, but they get caught.
In fact, those Nigerians...
It's tit for tat.
But they get caught. They get caught. The UK government, when you're leaving the country, they stop them. They said, well, I see you came to play 2 days ago. Did you pay the tax? Oh, no, they get into trouble.
Thank you. In fact, when you look at Nigeria, to some extent, they are a bit liberal in terms of taxes. Those that are outside other jurisdictions, they are so stiff and strict on taxes. So when you are from a DTA, that's the provision of a double taxation to come in now. Article 2023 will apply. So you can eliminate those ones. So that's why for us to get the data, the challenge now is not this one, how do we get the data? That's why we're having a close collaboration with agencies, particularly Nigerian Immigration Services. So we are having in a close working relationship. In fact, within a field, we have reached advanced stage, 70, 75, 80%. By the time we conclude, I think we'll be able to close this gap. And then going back, you mentioned something about BVN, NIN. These are all ideas that are coming, but I don't want to throw all those.
You don't want to frighten us.
I don't want to throw all those things out. But at least Nigeria is waking up. No, based on experience, based on experience, that window for those that are coming within that less than 183 days, it's a huge gap. A lot of money will go out there. You find few consultants or will come for a few days in oil and gas company, they will pay a large sum of money in terms of either consultancy or something like that. This is shifting of profit. Okay? So if you can take our withholding tax, even if it is 5%, even if it's the 10% maximum, at least we have gotten something, but we have been losing that tax for a very long time. Based on experience, there is one company, 2 or 3 oil and gas that are filing payee of those non-residents. It's huge money. I'm telling you, huge money in a year, almost going to billions. So if the whole multinational are doing that one, and I believe they all have it, so the only data I need, I just need to get collaboration with immigration. By the time they provide me the data, I'll just file to all those guys. No, that's it. So Tozai will be busy.
We're in trouble,
a lot of things to work. And then, the proprietary technology, the digitals they are using payment gateways. The payment gateways of all the digital will either be through CBN or NCC.
Correct.
NCC may not have direct control, but NCC control all the telcos. All the platforms we are using, Zoom, WhatsApp, whatever, call them, they are passing through those platforms. So, in fact, interagency collaboration is one of the main core that I'm disturbing and studying with my chief executive chairman with it. And by that idea, we are going through that one. So by the time we have those interagency collaborations, all the global digital, come, voluntary, comply, register, we don't stop you. Few of them did. They came in, they registered through VAT. They've been filing VAT from offshore. Yeah. So that's what I say. You don't need to come to Nigeria to register to comply for taxes in Nigeria. You don't need. So just contact. We'll give you all the details you need, all the accounts that you need to pay. You don't need to come here. So it's simple. So what we are just asking, voluntarily complied. We don't want to go to a stage that we have implemented that technology. We have gotten all the collaboration with our sister agencies that have control. No country, no matter how that is porous, at least we have regulation. Okay, for the platform to operate, they have this, and they have to pass through the platforms. So those platforms, they are in regulations. Okay, so by the time you come to a point that NCC or the telecom will block you, this thing is embarrassing. I don't think there is any digital company that may like to go into that.
Wow.
So that's why we are saying, okay, fine, come in, voluntarily comply, and then help Nigeria to generate VAT. In fact, for God's sake, it's just a transaction taxes. It's not your income tax. Then the argument of income tax will come in when Tozaya and then OECD, they're saying no, this and that, while many countries have come up with unilateral measures. French in particular, France, you all know it. You all know the digital service, France and the US. So since we are talking to France people, don't say, why did you introduce SEP? Our SEP is even simpler than you have to file.
I suggest you go on with the rest of the questions.
There's another question. There's another question I had, of which my sister threw to me when she was making presentation, that they changed the minimum tax along the way, 0.5 to 0.2. Yes. How does it apply? As a taxpayer, if you have a genuine reason, number one, what we need to know, those people that are affected is those that already filed minimum tax.
Yes.
You have reduced the large. You have reduced the burden. Okay, how many filed minimum tax? 20, 30, 100, whatever they are. Can you prove to us that you filed minimum tax? Oh, I've already filed in 2019. What's the impact now? I have 50% returns. File your next return in 2020.
Okay, get it.
If you can ask, you can file your next returns and then take off the excess you have suffered. It's
this
simple.
Is fantastic.
The reform
news.
No, it's simple. The reform mechanism is two. Either you get your cash or you get your credit. So how you can credit for what your tax you have paid as a result of the changes of this, and just stating your returns. Nobody will query it. I don't think there's any tax officer that will query it.
Okay. I'll have you know that I've recorded your answer. And when I bring my clients,
file your returns.
I've recorded it.
Prove to me that you have suffered 5% minimum tax in 2020, and then in 2021 you have that excess tax you suffered. Take it off. I will not query your returns. In fact, I'll be more comfortable with that one than saying you want to ask for cash. Because if you're asking for cash, the procedure of coming, I will come and audit you will come in. I know even the taxpayer will be better off filing and taking off the excess in the subsequent year. So I think communication using this one. Okay, fine. There are issues of technology and then stamp, additive stamp, either NIPOS or not. There are some areas that are a little bit either controversial or need further guidance and clearance. I don't want to jump into there because certainly Finance Act is just coming in 2020. There will be a guideline by FRS, okay, how to work. Those FRS that have absolute control, there will be a guideline. Those FRS have sister agencies, there will be another guideline for that one. So honestly, I don't want to jump into that one. Let's wait and see what will come up on that one.
That's okay.
Yeah, thank you. I think I have answered the questions that we have.
Thank you very much, Mr. Liu. In fact, this conversation is driving itself. I just had to stay back and then watch things take its own tour by itself, because of course it's a very practical issue. It's an issue that affects all businesses. It's an issue that affects everybody. When you mention tax, everybody will wake up from sleep. It's a normal thing. You understand? This is Nigeria. Even it's as a global issue. Everybody, we talk about the issues on taxation. And we are 2 minutes above our scheduled time. But let's see how we can still get one or two things. I don't know, Mr. Imo. I don't know. You have one or two things to say based on the question that we asked.
The question was about, let me remind myself, whether free-zone entities file transfer pricing returns.
Yes.
Well, that's more a question I would have said for the taxman to answer, because the idea of filing tax returns is new. Now, most of the time, transfer pricing returns are relevant because they impact on your tax returns. They're trying to see from the transfer pricing returns whether you have allocated, value appropriately between your different group companies around the world. Now, if you're not liable to tax in the first place, then it doesn't really matter how you allocate, those values. If you move profits from Nigeria out of from another country into Nigeria, it shouldn't really make a difference. So I'm just wondering why it would be. You'd want to ask companies to go to this extra burden, because it is a lot of work about tax pricing returns. It's more work than filing tax returns. So I'm hoping they will not insist on that.
Sorry, do I make just one comment?
Okay, I'll let you go before I make my comment.
Why not go? Let me hear you before. Okay. Go.
I think for me the critical question is, does the tax authority and does the tax law and the transfer pricing regulation view transfer pricing returns as a component part of your annual tax income of your annual income tax returns. So if transfer pricing returns is a component part of your annual CIT returns, then I imagine that as a free zone entity, if you had to file CIT returns and transfer pricing returns is a part of CIT returns, then you may have an exposure there. But if you then don't have any related party transactions, then I presume your exposure is little to nothing, really.
I mean, I agree with you that that may be the case, but I'm hoping the revenue will come out with regulations that would save people that trouble, because there's a lot of trouble when you know that at the end of the day there will be no tax to be paid. You know, I mean, you know how big those things are in terms of volume of documents. You know, and transfer pricing is not just about tax; it's partly economics and things like that. So there are a lot of skills that come into it. A lot of people, advisors, consultants that come into it. So it's a lot of work and a lot of expense to do something that would really lead to tax for anybody. But I agree with you that if the two are meant to go together, then yeah. I'm hoping the FIS. That's what I'm saying. I hope they do it insist. But if they do it,
yes. So we're begging you.
Okay.
So back to you.
Just a minute. When you are thinking of transfer pricing and then taxation of non-residents, sometimes people may tend to mix it a little. If you are dealing with taxation of non-resident, you are strictly or specifically dealing with the PEs. Okay. A non-resident company is dealing or having transaction with PE in Nigeria. So we can just treat you based on PE. Transfer pricing will come in when you have a related party transaction. So mostly those that are affected by transfer pricing are Nigerian subsidiaries. And Nigerian subsidiaries by tax law, they are Nigerian taxpayers. Are we together? They are Nigerian taxpayers. So in most cases, you will find that they have that transaction with other parents companies or other related companies. That's why.
Yeah, what if they're in a free zone? What if they're in a free zone?
No.
Yeah.
A free zone that is coming up now, okay? It's just in compliance with section 52 of CETA. A company, either you are to pay tax or you are not to pay tax, you are bound to file your tax return. You get it? File your tax return. There are many companies in Pioneer enjoying Pioneer incentive. You should file your tax returns.
Yeah, no, Pioneer is
not paying taxes. No. Free zone. It's the same idea. You are saying that you are not paying tax. That's why you don't want to file tax. But in most cases, experience have shown that those free zones, they are dealing with custom territories. You get it? So they're having that dealing with custom territories. For you to comply with that company income tax, okay, you are bound to file your tax returns based on section 52 of CETA. File it and say, oh, all my income is from free trade zone. I'm not taxable. We want to see you.
Okay, but do they have to file transfer
pricing returns as well?
Will you ask for transfer pricing returns as well?
If they have a related party transaction, Trade P regulation is clear. They should file. They are not exempted. No, they are not exempted. TP regulation is unrelated party transaction, section 22 of CETA. Once that element is there, file it and tell us that your related party you are dealing to is in free zone in Mauritius or Cayman Island or anywhere. File, let's see. That's its compliance.
Okay, so you want the information. So you may not, get to ask for tax, but you need the information.
Yeah.
Just for the record. Okay.
Yeah, so that aligns with the point I had made earlier on when I was talking about free zone entities filing tax returns. Yeah. My understanding is just for sharing of information and transparency.
Yeah,
really.
Yeah, of course. Go for compliance. Just file it and let's go. Not necessarily are paying you tax. It's the same law that exempted you, so you are free. That's why I gave example with Pioneer. He's not paying taxes, but you are bound to file your tax returns. I mean.
But Pioneer is slightly different because they have to, for example, accrue their capital expenses until year 5, and then they start applying. So you need to have a record.
Some will go with arguments. Okay, I will be keeping my record until after my 3 years or 5 years. I will bring all the capital allowance. You know what the capital allowance is? Someone will bring that argument. Don't disturb me. Filing of tax is to pay tax now. I'm not filing. I have all my record. After 4 or 3 years or 5 years, I'll give you. So now that they say, law, no, comply with the law, file on annual. Let's see it. We know. It's the same law that exempted you from paying taxes. Okay, go ahead. Yeah.
Any more questions, Moses?
Thank you.
There was a question on capital gains. Why we have two?
Yes. 2 days.
I would like to think that we have 2 dates because over the course of the year, you may enter into various transactions that are chargeable to capital gains. So, and also the FIRS is keen on raising their revenues and collecting their cash
quickly.
So, yes. So it's better if I can take my money twice in a year than wait once a year to get my money out of you. So it probably is a cash management provision, and the fact that transactions occur at different times in a year. It's not only once in a year that chargeable transactions are entered into. And also the law just specifies filed 2 times in a year. So that's that.
Okay. Mr. Jibola, you want to say something? Mr. Jibola?
Is he here?
Yes, thank you very much. I just thought I should add a comment to that particular subject of the capital gains tax, because if you think about the current framework, the tax is paid retrospectively because we use a prior year tax framework. So if you dispose of a chargeable asset in 1 year, under the previous framework, you would only file your capital gains tax return at the same time as you are filing your income tax return, which is on a previous year basis. So if you did a transaction in 2020, you would only be filing your capital gains tax return in 2021, typically 1.5 years after the transaction itself. So obviously, government is out of pocket for 1.5 years.
Mm-hmm.
So the idea was to move away from the tie-up with income tax by making taxpayers pay the tax in a more prompt manner, which Tozaya has also spoken to. That was the whole idea behind this. It's an initial step. The Capital Gains Tax Act itself is a very old law that is requiring updates. So this is the first step towards modernizing our capital gains tax framework. You should expect that more changes will come, either through future Finance Act legislation, or by a wholesale modernization of the capital gains tax in itself. Thank you very much.
Thank you very much, Mr. Jibola, for weighing in. Thank you very much for that. We've actually crossed our time. We still have questions from Delta Lift, and though the question they're asking is the status or existence of bilateral agreements with the US and Eurozone on double taxation. I don't think it's within our framework. It's something that we can always email to Mr. Aliyu directly later. I'll prefer to keep it French and for now. And of course, UBA, they're asking on the implications of the Finance Act for MSMEs. Of course, I think we have a little for MSMEs. I think Tozaya, you can just weigh in on that in 1 or 2 minutes, and then we get final words and we can wrap up.
Well, there are Greek exemptions for MSMEs, tax holidays. I imagine now that to be administered under the Pioneer Incentive Act. Then the tax incentives introduced in 2019 Financial Act for MSME still exist. So if you're an MSME in the agri space, depending on how much revenue you generate, you may be entitled to. No, actually, if you're an MSME in the agri space, you can enjoy up to 6 years tax holiday. If you're an MSME in other spaces, you can enjoy reduced tax rates depending on your threshold of income. So if you are small, micro, and you earn less than 25 million, then you enjoy CIT and I believe VAT exemption. However, you still have to file your tax returns and provide the revenue with information on your activities.
Thank you very much. One Mr. David Mija of CADAP World Incorporated Company, I think is asking Mr. Liu whether companies that are non-resident operating in the digital space in Nigeria can use the cash register as a record-keeping tool to help FIRS to get their records for tax purposes, and they can use their own cash register applications as long as it provides real-time information FRS. It's something I will email that to you later and see if we can be able to give you a response, because we're already totally out of time. So I'd love to get final words from all the speakers this morning. I'll start with Mr. Liu. Please, your final words, please. Just in a minute.
Thank you very much. That's a good opportunity to be here. And then I will still repeat my appeal. I think I'm appealing to all the non-residents. Come up, voluntarily complied. Federal government of Nigeria is coming up. We are going into collaboration with all our regulatory sister agencies, and no hiding space. And registration for non-resident and then complying with the tax laws in Nigeria is very simple, straightforward. You don't need to come to Nigeria. Just contact the non-resident person tax office. We'll provide you with all the information you need. Thank you.
Thank you very much. Mr. Jubola, you have anything to say? Just a minute.
Well, thank you very much. What I will say is that Nigeria is doing its best to be a member of the Committee of Nations and to be in harmony with the rest of the world. The changes that are being introduced through the Finance Act legislations and through tax modifications are designed to bring Nigeria into consistency with what the rest of the world is doing, and they must be applauded. There will be gaps, there will be areas that need to be clarified, there will be errors, and those errors will then be corrected later on. And what we would appeal to all taxpayers to do is to always consult with their tax consultants. Also, be willing to engage with the Federal Inland Revenue Service, who over the last year of the pandemic have been very cooperative and very supportive of businesses that are suffering the effect of COVID-19. FRS has showed itself to be a regulatory agency that is sensitive and that can be trusted to understand the situation. So we encourage everyone, speak to your tax consultants, speak to your lawyers, engage with the FRS, and let's work together to build a Nigeria of our dreams. Thank you very much.
Thank you very much. Mr. Zaye Balogun, please.
Well, thank you for inviting me to this session. It's been a robust session, and I have learned a lot from the FRS official. And I believe attendees too would have taken value from this session. The other thing I'd like to say is just emphasize the point Ajibola has made, which is that the government wants Nigeria's tax system to align with global best practice. And this is the reason why every year we make incremental changes in our Finance Act. So changes that we haven't yet seen in the 2019 Finance Act or 2020 Finance Act may be introduced in 2021, 2022 Finance Act. The point to the Finance Act exercise is to fix controversial issues in Nigerian tax law and to ensure that Nigeria's tax framework aligns with global best practices.
Thank you very much for that. Mr. Theophilos, please.
Yes, well, thank you to Fncci for agreeing to partner with us in hosting this. I will join Jibola in saying that yes, the Nigerian government is trying to generate more tax revenue. The ratio of tax revenue to GDP in Nigeria is probably one of the lowest in the world. I mean, many people may not realize that it is as low as 6 or 7% at best. Whereas in Africa, it's closer to 20% in many countries in Africa. Then when you get to Europe, in some countries in Europe, it's closer to 40%. And that is why they can provide the services that we travel on holidays to go and enjoy. You know, without that money, they wouldn't be able to provide those services. So for us to create a country that can also provide those services, we need to do something about, you know, the money that is made available. But of course, the flip side is, you know, when the money is made available, you know, it should be properly used. And that is why there is some, you know, trust deficit between taxpayer and tax collector. I mean, Mr. Liu, you know, I'm sure you feel this when people come, you know, I mean, sometimes they want to comply, but they're wondering, okay, when I finish paying, I still have to go away and put on my generator, you know, supply myself with water through a borehole, fix my road in my estate. So what am I paying this money for? So that's the message that needs to go back upstairs for them to realize that without this trust deficit being, closed, you will continue running after the taxpayer, and the taxpayer will continue running away from you. Not because they don't want to pay, but because they're not sure that they're paying, for anything. So that's the point. I mean, I'm not, making the government's case. I act for taxpayers, but my role usually is to tell the taxpayer what the correct thing is. But when they are being asked to pay the wrong amount, yes, we will, challenge the tax authorities, and quite often, our challenge is successful. But we do need more money to make this country a better country. And what the government is doing is simply trying to collect what the law already provides for. And I'm hoping that, with the use of technology, they'll get better at this. But the flip side is they should use the money properly. Thank you.
Thank you very much, Mr. Emoa. You have said a lot, and you have touched areas that I wanted to touch on, definitely, on the trust gap and other areas we've mentioned. Thank you very much for that. Monsieur William, do you want to say something to wrap up?
Yes, no, once again, thank you very much to the chamber to have organized this webinar. Very useful. Thank you to all the panelists. It was actually very insightful. I learned quite a lot of things myself. Thank you especially to the FIRS for all the details that we got from the Finance Act itself. It was so once again very useful. Thank you for those also frank discussions, and also the analysis we could have from the consultant that were here. And again, thank you to all of you for participating today.
Thank you very much, Mr. William. And like Mr. Ajibola said, ensure that you work closely with your tax consultant, because of course, this information, they are very robust. Work with your lawyers, work with your tax consultants. And of course, the gazetted copy of the Finance Act 2020 is out. FRS guys will come into your office, and if you are not informed, in fact, because we get that a lot. If you're not informed, that's why you have to work with Aelex. You have to work with the people from KPMG. It's important so that you can be able to, not to beat FRS. So that's not the objective, not to fight them, but of course to stay informed and ensure that everything is done well. So once again, on behalf of the board of directors of the Chamber of Commerce, we thank Aelex for being part of this event. And someone has asked if the video will be available. Yes, the Franco-Nigerian Chamber of Commerce YouTube page will have this video in the next few minutes, so you can just you can go there and then you can rewatch the whole clip, and it's the conversation drove itself, definitely. So it's something that you can relate with when you watch. And the presentations made by KPMG and the FRS tax consultants will be made available to all participants this morning. So once again, thank you very much for joining us this morning. Until we meet again, and merci beaucoup. Over. Bye bye.
Au revoir.
Merci. Au revoir.
Au revoir.
Au revoir.
Merci beaucoup. Au revoir. Okay, thank you.
Bye bye.
Thank you.
Merci. À bientôt.